Thank you. I would like to welcome everyone to Orocobre's activity briefing for the June 2020 quarter. Firstly, I would like to reiterate that during these unprecedented times of COVID-19, the safety, health, and well-being of all employees, their families, communities, and other stakeholders is the number one priority of the company. Since operations recommenced in early April, we have continued with a detailed biosecurity protocol at all of our operations. This has been done in accordance with established national regulations and best practice approaches within the industry. Our emergency committee, comprising of both Sales de Jujuy and Borax Argentina personnel, has continued to coordinate operations and enforce the application of the biosecurity protocol. So far, our thorough preparation and robust execution of COVID precautions have been successful in preventing infection at any of our sites. However, we remain very concerned as there has been significant infection of employees at other nearby operations that has resulted in the spread of COVID into local communities. Clearly, there is now a risk that our own employees will be exposed to COVID when they are at home and then bring this to our operations. Although we are prepared for this eventuality, we will continue with our extensive precautions to minimize this risk. On specific safety issues, we saw 3 lost time injuries during the quarter in Borax at the Tincalayu and Sijes sites. As of 30 June, all AROs achieved 160 days without an LTI, and the Campo Quijano site at Borax had achieved 456 days without a lost time injury. Moving on to the results for the June quarter, the Olaroz lithium facility recommenced production on 9 April following a closure due to COVID-19 restrictions in late March. Production for the quarter of 2,511 tons was down 27% on the previous corresponding period. This was due to a temporary plant shutdown that commenced in late March and scaling of production to sales demand. Sales volume for the quarter was materially impacted by COVID-19 and was down 36% quarter-on-quarter to 1,601 tons, while sales revenue was down 48% quarter-on-quarter to $6.3 million. The realized average price was $3,913 per ton on a free-on-board basis, after final adjustments with continuing weak demand and aggressive competitor behavior. Sales volume were approximately 29% battery-grade lithium carbonate and the remainder primary-grade lithium carbonate. Cash costs and cost of goods sold basis were $3,920 per ton, excluding the export tax of $151 per ton for the quarter, and COVID-19 related costs of $940,000. This is the best quarterly cost result in the last 3 years. Total cost of sales has remained at recent lows despite reduced sales and production volumes, demonstrating the significant focus on reduction of fixed costs within the operating business. The improvement in fixed cost is largely due to a significant reduction in contractors and consultants across the business, reduction in prices of energy and site-related services, resulting from improved commercial agreements and elimination of all non-essential spend. The lower throughput rates have enabled our team to perform tests and improvements that resulted in operational efficiencies that have delivered pleasantly low operating costs, considering the reduced unit volume over which fixed costs must be attributed. We trust these learnings, along with the fixed cost reduction, will deliver better results in the near future. Our operations continue to enforce strict biosecurity measures with daily monitoring of employee health and detailed planning should COVID-19 be detected within the workforce. Moving on to the lithium growth project, a significant review of the Stage 2 expansion projects has determined that the total capital expenditure will be approximately $330 million. The key areas of cost escalation are with more robust technology related to the carbonation process, management of impurities in the soda ash system, and improved flexibility in the liming process. Project completion will be delayed with COVID-19 restrictions in play. However, work will be progressed as quickly as possible. Construction of Stage 2 was severely impacted during the quarter by COVID-19 restrictions, Construction ceased in late March and only recommenced on 29 April. Site works continue to be limited, and project construction has only progressed slightly from the end of the March quarter to approximately 40% completion, with a total spend of 139 million. The Naraha lithium hydroxide plant construction has achieved approximately 70% completion. However, some equipment deliveries from overseas are expected to be delayed due to COVID-19. This is likely to impact the final completion by approximately 2 months. I will now pass over to Tara to discuss the lithium markets.
Thanks, Martin. The continued spread of COVID-19 during the June quarter further challenged the sluggish supply chain. Raw materials production proved more resilient to the pandemic impact compared to mid and downstream cathode, battery, and EV manufacturing facilities, which mostly ceased production for between 2 to 4 weeks. In some cases, the downstream facilities retooled for production of medical-related equipment and masks. The pace at which downstream operations recommenced and ramped up battery and EV production varied throughout the industry, depending on inventory levels and customer order backlogs. Consumer demand in China was largely subdued despite the extension of China's EV subsidy program, further provincial level support programs, and an easing of the most severe COVID-19 restrictions. Foreign EV manufacturers performed well in China as additional features and perceived international brand prestige enticed first-time EV purchasers and converted traditional buyers of domestic brands. Weak demand and growing inventory saw aggressive sales behavior by some spodumene and lithium chemical producers seeking to maintain cash flow, minimize unit costs, and/or grow market share at the expense of price. Growth in supply from some South American brine producers to the Chinese market increasingly displaced independent hard rock producers and marginal Chinese converters operating on slim margins. As a result, less experienced and higher cost Chinese conversion plants began to idle facilities and/or further moderate production. Meanwhile, independent hard rock producers adopted mixed and contrasting strategies. Some continued to follow a campaign-based approach, while others aimed to maximize output and gain unit cost benefits. Overall utilization rates of Australian hard rock producers were significantly lower than recent quarters, aligning with independent Chinese conversion plants operating at or below 50%. During the quarter, widespread delays to lithium expansion projects were announced, reflecting market conditions, limitations on project workforce availability, and lower plant and equipment availability. The prolonged, subdued market conditions have, in part, overshadowed the potential medium to long-term improvements these project delays will have on industry pricing and structure. EV manufacturers were encouraged by positive signals coming out of the European Union as member states reaffirmed green industries will be used as a key platform for economic recovery post-COVID. The EU announced a green recovery plan providing 20 billion euros to projects that delivered some form of environmental benefit, such as lowered carbon emissions. In addition, during the quarter, there were further promising announcements regarding battery and EV manufacturing partnerships, and even retooling of production facilities from internal combustion engine vehicle production to EVs. In the short term, the lithium market has suffered an undeniable setback due to COVID-19. However, the medium to long-term outlook remains exceedingly positive and continues to be further reinforced with increasing government regulation and funding. I will now hand back to Martin to complete the presentation.
Thanks, Tara. Borax Argentina was also temporarily shut due to quarantine restrictions, but operations have now recommenced with some ongoing restrictions due to biosecurity measures. Sales revenue was up 3% quarter-on-quarter. However, the average price received was down 10% quarter-on-quarter. Moving on to corporate matters, at the end of the quarter, Orocobre had available cash of 154.9 million, of which 11.1 million and 36 million have been set aside as guarantees for the Naraha debt facility and Olaroz expansion debt facility, respectively. Agreement has been reached with Toyota Tsusho Corporation, TTC, to release 60 million from the 135 million that was previously required to be restricted as cash guarantee for the Stage 2 Mizuho loan. Additional funding will be available for all our project-related costs. The change will result in only 75 million being restricted from the Orocobre corporate cash balance, although this remains available for any further Stage 2 capital cost overruns, VAT, and working capital. Recognizing market conditions and in accordance with relevant accounting standards, Orocobre expects to recognize a non-cash pre-tax impairment charge of approximately 28 million in its 30 June 2020 annual results. This impairment is related to finished goods and brine inventory, asset revaluation, and the acquisition of Advantage Lithium that was completed during the quarter. The impairment assessment calculation is ongoing and will be completed as part of the preparation of Orocobre's financial year 2020 audited financial report. Overall, this has been another turbulent period, but one in which operational improvements were still achieved at both Olaroz and Borax. We continue to monitor global health and economic development and will update shareholders as the impact upon our business becomes clear. I will now hand back to the operator for questions.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star then 2. For those on the webcast, to ask a question, please type your question into the Ask a Question box. The first phone question today comes from Reg Spencer from Canaccord. Please go ahead.
Thanks. Good morning, Martín and team. A few questions from me. Just starting with the operating costs at Olaroz. They look pretty good relative to the low rates of production. I was just wondering if you could comment on whether or not those additional costs from COVID impacts, which look like they equate to just under $400 a tonne, are they likely to be one-offs, or can we expect a proportion of that to be ongoing as long as these disruptions continue?
Thank you, Reg, for your question. The basic, Neil, you can complete the answer. The costs that you see due to COVID are related to the time during which the plant was shut down. Going forward, as we continue to work on the COVID protocols, there may be increased costs if testing becomes more wide among the workers. So far, we have been able to record a very good peak without any COVID case registered within our operations, following a very strict biosafety protocol. On the operating costs, the most important thing to highlight is what we are saying in this quarter is a reflection of a reduction in fixed costs. That was mostly a consequence of reducing consultants, contractors, and other fixed associated costs. Leveraging on the operating cost, variable cost, mostly reduction of reagents and improved recovery during the first quarters of the year, enabled us to deliver this number in terms of costs. Neil, if you can complete the answer, please go ahead.
Yeah, the only thing I'd add was, as Martín explained, the fixed costs have come down substantially. So when you've got a fixed cost for a month, you'll divide that by the tons produced, and then the cost of sale will include that that cost per ton, whereas what's left over will go into inventory at that cost. So basically, we produced 2,500, a little over 2,500 tons. We sold 1,600 tons. So you'd have 1,600 tons, which would pick up that fixed cost, which would have been divided by the 2,500 tons. So that's how it would work, but we've reduced those fixed costs substantially.
Okay, that's great. And are those, is that fixed cost reduction permanent in nature, or again, due to the limited activities and operations on site?
No, it's permanent in nature. It's Martin, do you want to go ahead, or I can go ahead?
No. Sorry for that.
No, what I was saying, it's permanent. It's in terms of we've reduced contractor usage heavily. We're using our own employees for most of the tasks, so that's not going to come back. We had energy reductions, a lot of non-essential spend.
Understood. And Neil, can you just remind me of the fixed versus variable cost split? And are you able to quantify that percentage reduction in fixed costs, or maybe we can take that offline perhaps?
Yeah, we may want to take that offline. I mean, it has been a substantial reduction. Fixed to variable is roughly about 58% fixed, 42% variable. And obviously those expenses, the savings I was talking about earlier as well, subject to Forex, the USD and peso rate. So that would have to be taken into account as that fluctuates. But yeah, I think I covered off on what you had asked. 58-42 fixed variable, and the cost reduction has been substantial in terms of the
Great.
Yeah.
Thanks, Neil. Just one more question on production outlook before I pass it on. Can we presume that, given the market outlook in the near term remains uncertain, that your production will remain at moderated levels? And if so, can we just assume that what you did in the June quarter should persist, for example, for the next 6 months until things improve? Or I'm just trying to get a feel for how we should think about likely production levels, sales levels, and what that might mean for your inventories over the next 6 months, please.
We to answer your question, it's actually many questions into one with regards to operation for the current quarter. The plant is now into maintenance. We expect a 2 weeks maintenance. We advanced it to make it overlap with the peak of the COVID situation in the province of Jujuy. Inventory, as we've been producing more than what we've been selling in the last quarter, we're carrying a bit more of inventory, which will be downloaded to the market in this quarter. We're increasing amounts of sales from previous quarter in this, which should be better tons. And with regards to production rates, once we complete the maintenance period, we should, slowly go back into our normal production rate, depending on how we see the market recovering. In the previous quarter, we had to slow down production as a consequence of lower amount of sales. So we'll continue to work, taking all that into consideration in terms of production, maybe a similar quarter.
Okay, great. Thank you. Very quickly, last one. I presume it's too early to give us an indication as to when you think construction activities will commence in full swing on stage 2. Thanks very much for the increased detail on the higher CapEx, but just some comments, if you can, on timelines for stage 2.
I will use the "if you can" qualification on your question. It's very difficult today to tell you something, Regis. We're at the peak of the COVID situation. We're operating with a small crew of people on the expansion, and it will be very difficult to give you a timeline for the expansion until we can commence with full crews on the works that we are performing.
Understood. Thanks very much, guys. Appreciate it. I'll pass it on now.
Thank you. The next question comes from Joel Jackson from BMO Capital Markets. Please go ahead.
Hi, this is Bria Murphy on for Joel. Thanks for taking my question. I'm just wondering if you could talk about how price realizations are faring in the September quarter. Are you seeing any sort of improvement in pricing? I know it's early, but even some direction guidance. Thanks.
Martin, do you want me to pick that up?
If Tara can help me. Yes, please.
That was regarding pricing. It was a little unclear over the telephone. So just.
Sorry. Yeah.
What pricing looks like in September quarter? Is that what your question was? Well, we're not seeing any recovery in pricing in September. We still see it as being a fairly weak quarter in terms of pricing. We do expect to sell substantially more tons, but than the June quarter. However, pricing is expected to be weak.
Okay, and then just maybe one for Tara. Just wondering if you could talk about how demand is faring in different regions, and what kind of inventory levels you're seeing. Thanks.
Sure. Thanks for the question, Bree. I guess it's a little bit of a diverse sort of demand situation geographically. We haven't seen China recover from COVID particularly well, despite the extension of the EV subsidy, and there's a widespread provincial level subsidies being in place. So unfortunately, China isn't recovering very well. But on the flip side, as it's been widely promoted in the media, Europe has recovered very well and quicker than expected. It's only been down. The only month that it's been down year on year was in April. So it's recovered quite quickly and is now actually surpassed China in terms of EV, how much it accounts for global EV sales. So it's up to 42% year to date. So in terms of the outlook for the second half, we expect that Europe will. We're seeing definitely Europe's momentum continuing, and a lot of hope around the EV subsidies that have been in place around in the key European car markets like Germany and France, where they have where the EV subsidies actually conclude either this year or next year, creating some sense of urgency. So that could really help to get the momentum to lift the market early next year. We'll perhaps see a meaningful shift in inventory and reflected in prices. So, and to answer the second part of your question, Bree, we think that inventory levels are currently around approaching sort of 6 months, as opposed to historical levels that are around 3 months. There was some destocking pre-COVID, but unfortunately with the downstream impacted at a greater extent than upstream, we've seen that inventory levels have crept back up.
Great, thank you. That's it from me.
Great.
Thank you. The next question comes from Levi Spry from JP Morgan. Please go ahead.
Hi, g'day guys. Thanks for the call in these difficult times. My questions are pretty similar to Reg's. So just the obvious guidance question, like when it's hard, but what else can you give us in terms of helping us to model production and sales?
As we said before, in the current market situation, we retire guidance from the market, and we are not. Well, it's very difficult to give you any guidance in the current situation, apart from what Neil mentioned, that of prices still being weak, and expecting to have a similar quarter, a bit better maybe in terms of production and sales, but very, very difficult to tell you this time.
Okay, thanks, Martin. And and the stage 2 funding question, can you?
Sorry, guys. Yeah.
Yep.
Yeah, I'm sorry, Fred, whether Neil wanted to add something.
No. I think that's spot on what Martin's saying. I mean, at this point, Levi, very, very difficult to give any guidance on other than what I mentioned. I mean, it's so difficult under these circumstances of COVID, and we can't say much more.
Yep. Okay. Thank you. And stage 2 funding question, just how you're thinking about it, risks. Can you maybe just talk to it a little bit more and address if it is more than 330, how you'll fund that?
Well, we have the funds available. Remember that we had $135 million in the guarantee account. The agreement that we reached with Toyota Tsusho to be able to use up to $60 million of that guarantee account for cash needs on stage 1, given the current situation. But remaining amount, 75 plus the unused portion on the 60, are available to fund any cost overruns on the project. So the cost increase is going to be funded from there, as well as VAT and working capital. So there are no doubts on the funding of the project. The Mizuho loan is being disbursed. We've already contributed $132 million in shareholder loans to the project. There's 180 coming down from Mizuho in terms of loan need. Who knows exactly how much has been disbursed already, and we're doing the details are there in the press release, and we can get them from the team.
Okay, thank you.
You're welcome.
Thank you. The next question comes from Rahul Anand from Morgan Stanley. Please go ahead.
Hello, Martin and Neil. How are you? I have 4 questions, if I may. First one's for Neil. Neil, you flagged sales costs today. How are the production costs tracking?
Also very well.
In line, above, below, or how should we think about that?
We're continually improving. We're improving month on month. As I said, in terms of the production costs, we've had heavy savings or substantial savings, I should say, in fixed costs. So that reduction has been very beneficial to us. So it'll be consistent, and we expect that to continue.
So then the average cost of inventories at the moment is lower than the sold costs. Is that fair?
Sorry, say again, Rahul?
Yep. So the average inventory costs at the moment, would that be lower than your sales costs?
No, well, given the weak pricing, you would have seen that in the quarterly, there is impairment on inventory, which we're going to be booking in terms of inventory. So from that, we've got to book at the lower of cost and then realizable value. So based on our future book, we've had to take an impairment on industry. We still continue to work on it. The audit's ongoing, as you know, given we report at the end of August. But basically, there is a write-down of inventories, finished goods as well as brine inventory.
Gotcha. Perfect. Martin, one for you. Better battery grade sales this period. Is that purely because you had inventories of that stock, or is the plant doing better?
Well, it's because we this quarter had some more contracts of battery effect products, so those contracts were honored, and the amount of product that we sell in the spot market was reduced as a consequence of the situation in the market. So given that, the battery grade contracts represent a larger amount of the total site.
Understand.
And do better as well, but sales and production, they do have a mismatch. For example, now we have the plant under current maintenance, and we are continuing to deliver and honor our contracts from stock. So we're managing stock to be able to meet all contractual requirements.
Understood. Okay, so the plant's still about 2080?
Well, no, particularly the month of June was more purified than prime product. But we're managing that through another contract here. So maybe between 2080 to 3070, that's what you would see.
Okay, perfect. Thank you for that. And then next questions, in terms of the small increase in the capex for stage 2, is there anything in particular that you could point out that you perhaps changed in the design given learnings from stage 1?
Well, as we see more quality requirements from the customers in terms of lower amounts of impurities, the whole carbonation process has been improved to reduce the amount of impurities in the product. So that's where you see most of the increases coming. And there are some savings in some areas of the plant where we knew we could do better. Some savings have already been achieved in construction of ponds and else. And the most, we'll tell you the largest cost impact comes from the carbonation plant because of improved quality processes.
Okay, perfect. And then I guess finally is around the delays to stage 2. Does it make sense to perhaps go slower on that, or is that still, you're planning to go ahead as quickly as you can based on labour availability and COVID impacts, or would you market time the project somewhat?
Well, COVID impact is already slowing us down, so we'll have to see what happens after that. But we're all set to move ahead as restrictions start to fade away.
Okay. All right, perfect. Thank you very much for that.
Raul?
Yes, hi Neil.
Yeah, just a quick one. I mean, FY22, we basically fully contracted, so we'd want to ensure that we try and push forward as hard as possible on the expansion to meet that requirement. Just wanted to make that point.
No, that's very helpful. Thank you for that. That helps.
Sure.
Thank you. The next question comes from Nick Herbert from Credit Suisse. Please go ahead.
Thank you. Hi all. Just a few questions on the costs for me, please. So maybe for you, Neil, if that's okay. I guess current cost out, it looks like you've done pretty well. Has that now run its course? Or are there any sort of other projects or meaningful areas you think you could reduce those costs further, or unit cost reduction, or just down to production? And then just wondering how you're thinking about costs now in stage 2, given what you've reduced and what you've achieved in stage 1, and any of those sort of incremental design changes for stage 2. So give us a bit of an update there, please, on future expected costs of that type of business.
Martin, do you want me to go ahead, or do you want to?
Yes, please, Neil.
So Nick, on the costs, look, on fixed costs, we continue to, across the entire business, we continue to tighten our belts, which we started quite a while ago. The fixed costs have reduced, as you know, substantially at SDJ. We've done that corporately as well. We've had substantial savings corporately. We've also retrenched a few people in February, actually before COVID. So, from a fixed cost perspective, there will be areas where we can tweak it a little more. In terms of reagent usage, it's coming down to which the operations team is doing a fantastic job on, is the factors in terms of the different reagents that we use. And that's where a lot of energy and time has been put into. There have been some savings, and we continue to work on that. So we could tweak it down even further. You've got to look at the tons that are produced that spits out that cost per ton, because obviously if you have a quarter which has low tons being put through, like we had, and we came up with a good cost of 2,500 tons, a little over that, we still came up with a really good cost. So, once you start pushing 3,500 tons through the plant, you really start seeing the benefits of a low cost per ton. But what I do a lot of is looking at it on a dollar basis, because there you really see the savings, especially obviously in terms of the fixed costs. So yeah, I think there's a little bit more to be done, but we've arrived at a good place, but there may be a little bit further to go. In terms of stage 2, it's probably a little bit early to be giving guidance on what the cost per ton, the effect of stage 2 would be. I don't know if you want to add anything on that, Martin.
At this point in time, we think that it's difficult to give you guidance on the cost on stage 2. Obviously, we expect them to be at the current level or lower. And as Neil was mentioning, in the first part of the year, we focused on operational improvements, use of reagents and plant efficiency. Second half of the year, we focused on reducing the fixed costs, which we are seeing the results now. All in all, when we increase the tons being produced, it should result in a lower cost per ton basis as we're able to produce more and sell more tons. And the same should be translated into stage 2 in continuing to improve the costs. I will tell you the easy part was already done. It is possible to further reduce the costs, but it's not going to be as easy as it has been over the last year.
Yeah, understood. All right, thanks, gents.
Thank you. Once again, to ask a question, please press star 1 on your phone. For the webcast viewers, please type your question into the Ask a Question tab. The next phone question comes from Warren Edney from Ballyou. Please go ahead.
Hi, Martin. I have a question on sales. I just wondered, was the 1,600 tonnes a reflection of customer demand, or did it also have some COVID impact in terms of restrictions on transporting stuff across provincial borders, etc.?
I will tell you it was the COVID impact on customer demand. So far, we've been able to continue to deliver product from Argentina and for the product to the different provincial borders. Have to tell you, it hasn't been easy, but the team, in terms of logistics, has performed a great job in that regard.
Thank you.
Thank you. The next question comes from Glenn Lawcock from UBS. Please go ahead.
Hi, Martin. I just wanted to clarify, just the way I read the release today, I understand you've been access to the restricted. It says it says for any further stage 2 cost overruns. But then the sentence then goes on to say, if capital expenditure exceeds 330, Orocobre will be required to solely fund this by way of shareholder loans. So does that mean if the project keeps getting delayed due to COVID, and it sounds like obviously still a big risk, and we all know time is the biggest killer of any project in terms of capex spend. Is it right then? So if the project does get delayed and go above 330, you can't touch the restricted money for that extra bit. It doesn't seem to make sense. I'm just a bit confused. Thanks.
No, yes, we can touch the extra money on that. The issue is that we distribute the costs 75-25 with Toyota Tsusho Corporation. Whatever goes above 330 has to be funded not 75 but 100% by Orocobre and in the way of shareholder loans. So we will collect that money back from the project. And that could be funded from the remaining funds in the guarantee account. Is that clear, Glenn? Or...
Yeah, no, I think it is. So, yeah,
is that clearly explained? Yeah.
Yeah, I might take it offline with Andrew, but I think I get it. The next question, if I may, just Tara said she'd seen a meaningful shift in inventory. I just wanted to clarify: is it still rising or is it now falling? What's the sort of trend you're seeing in the inventory now today?
Yeah. So when I said that there was a meaningful shift in inventory, that was back at the end of 2019 calendar year, and then the impacts of COVID sort of, I guess, counteracted that. But I mean, speaking directly about inventory levels, I guess We've seen a meaningful decrease in hard rock exports out of Australia. They're down around year to date. They're down around 45%. So if that can be balanced out from with the same sort of decrease from South American brine, then we could definitely see a meaningful shift in inventories by the end of the year. So it really just rests on the behaviour of South American brine.
But if you had to look at sort of just sequentially month over month through the second quarter or the June quarter, is it now falling again as people come back to work and activity lists? I know you said China hasn't done as well as Europe on the rebound.
Mm-hmm.
Is it falling sequentially now month to month, the inventory?
Yeah, I'd definitely say that it's falling month to month, because we've seen month-on-month increases in China's EV sales, and we've seen month-on-month decreases in Australian hard rock exports. And we've also seen some of the Chinese marginal converters idling capacity. So, I mean, those three factors collectively would logically result in a decrease in inventories in the geography that the majority of the inventory is in, which is in China.
Yeah. And that 6 months is what, as at the end of June, is it your estimate is 6 months of inventory?
Yeah, as of the end of June.
All right, so it was high earlier in the quarter.
Mm-hmm.
And then just my final question, just maybe, Martin, if you could just remind me, then I know you can't give guidance for phase 2, but just remind me what was phase 2 costs supposed to look like? Thanks.
Well, the cost for, you're referring to operating cost for stage 2, is that right?
Yeah, the operating cost, just what it was meant to be before all the improvements.
Well, I haven't rechecked. We haven't run the operating cost based on the changes that we made to the carbonation plant, but I do expect them to be, and this is not a guidance, it's just an expectation at this time because I haven't rerun the costs. I expect them to be at the current level of cost or below the current plant. Stage 2 is only going to be primary, and the costs today are affected by production of primary and purified. So we always said that we expected primary cost for stage 2 to be around the $2,500 to $3,000 per ton. We have to rerun that with the modifications we made to the plant, but we expect them to be within that range.
Okay, that's great. Thanks very much.
Thank you. At this time, we're showing no further questions. I'll hand the conference back to Mr. Pérez de Solay for closing remarks.
Well, thank you very much for joining us this morning, and we should all see you shortly within a month for our annual consolidated results release.